So, welcome everybody. We want to talk about the business models of asset management in the future, of asset managers in the future. Therefore, we have a couple of experts in the field. We want to talk about the entire scope of business models. That is, for example, what about the operational base? What about the customers? What about new types of assets which could be included? What about the retail customers, the institutionals, and so on? How are the role of asset managers changing in terms of perspectives on the business models? That's what we want to talk about. And with this, I would like to do a quick round. Please, everybody, introduce himself and present you as a person, but also as a company. And then let's get started into the discussion. Christoph.
Yeah, more than happy to start. Thanks for having me here, Philipp. Christoph Hock, Head of Trading at Union Investment, and for more than 4 years now on the DLT blockchain topic, and also one of the key players at our firm with responsibility for strategic development when it comes to token economy and digital assets.
Hi, thanks for having me. Manuel Nordeste. I run the Fidelity Digital Assets business outside of the United States. Fidelity Digital Assets is a subsidiary of Fidelity. We run a custody and execution platform for crypto assets.
Hi, my name is Achim. I work for EUREX. EUREX is a sibling of Deutsche Börse Group. I'm here promoting our equity. Oh no, it's not an equity, it's a FTSE Bitcoin Index future. And thanks for having me.
So good afternoon also from my end. Malte Holzberger is my name. I'm working for US Asset Management, and specifically I'm the lead for all matters digital assets and DLT. So in short, obviously we're trying to figure out how we can use this type of technology and use case for creating certain advantages for us and our clients, of course. And yeah, looking forward to a good conversation today.
Thanks. Hi, my name is Friedrich Herzog. I'm the head of research at Crypto Finance Asset Management. So as the name suggests, I'm also in the crypto asset management, so I'm suiting the panel. But I've also spent many years on the traditional side, and certainly now can say seen both sides. So I'm excited to this panel.
Perfect. Welcome everybody, and let's directly jump into the topic. How will the operative model change of asset managers through the realm of digital assets? Maybe Christoph, we talked about. Maybe Friedrich, we talked about in our preparation call. We talked about setting up new products, for example. This could be one aspect to start with.
Yeah, certainly. So I think we've been through an interesting exercise of launching exchange-traded products in the tradition, which obviously is a traditional wrapper, right? And at the same time, we've actually looked at how does this work on-chain. So if we were to build an index product, for example, on-chain, how does that work? And I'll make a long story short, to set up the kind of same product, the underlying product with the underlying index, on-chain and DeFi took us, really in a sandbox environment, took us like 20 minutes, including fee setups, all sorts of setups that you usually go through. Whereas in the traditional world, to set up that wrapper with all the intermediaries and everything, took us north of 6 months. And with a lot of manual work, a lot of spreadsheets being sent around, Word documents, as you all probably know. And so I think that comparison and seeing that, I think definitely speaks to the fact that there is something there in the technology that could make things very much more effective from an operational perspective for asset managers.
Who of you guys want to add something concerning the operational basis of an asset manager?
You're more than happy to do so, Philipp. So from our perspective, token economy, digital assets, as a part of the bigger context, digitalization is a highly disruptive topic for the entire industry. So we discussed it several times. For me, it's the kind of Nokia moment for the finance industry. Lots of chances on the one hand, but on the other hand, if you get it in the wrong way, or if you're too late adopter, number of challenges which could damage a potential leading position you have in the industry right now. So therefore, what is it what we need to do to get it right? We need to define the right strategies for our clients. So we, as Union Investment, large German-based asset manager, we are a service provider for our investors, for our clients. So that's why we need the connect to get the connect to the client right. Point number 2 is we have to ensure that we have the right products in place. And at the moment, we are talking about tokenizing traditional financial products, talking about bonds, talking about digital stocks, which will be allowed from next year onwards, talking also about tokenizing some of our fund shares. And then it's also about infrastructure. And DLT, especially when looking at automation, will be a significant efficiency driver. So to make a long story short, I guess with the support of DLT, of blockchain, speed is a key topic. Lower risk is another key topic. More efficient processes, and at the end, it's having an even better offering for our client, and to bring costs down and to share these cost benefits with our investors. And then in a very big next step, we are looking at clearly new products. Tokenization of real estate will be a key theme, especially when focusing on ESG. Tokenization of carbon credits, tokenization of wind parks. So all products where, as a typical real investor, you can't you don't have accessibility today. As a part of token economy, due to the fractionalization, we will make these products tradable going forward and investable also for real investors. So it's not just a copy-paste of existing products to a new technology, but the investment horizon, the breadth of products we might offer going forward will widen significantly.
Yeah, Friedrich pointed it out very nicely. Right now, you set up a product, could be an ETN, ETP, whatever, and it would take you for months to set it up. And alternatively, with DLT technology and smart contracts, you could also set it up in 10 seconds. But then you don't have the regulatory compliance. Yeah, so it's probably not the technology which is the limiting factor. It's rather the regulatory side. So, but this doesn't change with blockchain technology, right? So let's move on with discussing the operational base. What is the operational base driven by? Is it the regulatory requirements, because this cannot be speeded up significantly? Or is it the technology base? This can be speeded up, right? Who wants to add something on these insights?
Maybe let me spend a few words on this, because I think this is really crucial, and maybe also to share some lights. I mean, we heard about the benefits, the potential behind using blockchain, its efficiency, its cost reduction, its access into existing but also future markets. But I guess we also have to acknowledge technology is one thing, regulation, just making sure things operate as they have to, as regulators and market participants expect, is a given thing. So there's no way around this. And I would also then share, I mean, based on the experiences, to give you an example, we've been pursuing 2 projects currently, one on a public chain, one on a private chain, when it comes to issuing fund shares. And I guess really that's the way to go. You really need to touch the technology, understand what it can do, but more importantly, make sure you have a comprehensive understanding from a regulatory perspective, what elements do work and which one do not yet fit. Because, and we talked about this also in previous sessions, there's elements like suitability, there's elements about AML, KYC, and technologically, I would agree this can both be handled on a public as well as a private model, but still to make it sound and working for daily operations is still a massive challenge.
I mean, one thing, you know, we've had a business in the crypto market for 5 years, right? And so we've had some pretty hands-on experience on, you know, some of the operational challenges that come up. And you know, the biggest technology issue isn't really the blockchain layer technology, is actually everything around it, right? One of the problems is 24/7. So are you going to have people staffing your operations over the weekends? Very simple things like that. Or funding, right? So somebody was mentioning earlier, not having cash on chain is a problem. So can your cash move as fast as your assets? And so there's a bunch, and then there's all the technology that, you know, a lot of the large asset managers and a lot of the sell-side banks still have stuff on mainframes, right? That needs a few hours to run overnight and update books and records and things like that. And so there's a lot of infrastructure. Yes, the blockchain level is pretty cutting edge, and it's, you know, I think you have a sufficient base of talent and engineers that can build a lot of very interesting proof of concepts at that layer. The next few years, I think, is really bringing the rest of the existing system up to speed into a market that is fundamentally sort of much faster moving.
Well, the alternative would be simply peer-to-peer investing. Yeah, we see that it works, but it's of course a very, very tiny fraction of the market. But at least it works, right? But you want to add something? Yeah.
Yeah, maybe. And exactly, this is one point why I'm sitting on this panel, which those experts like have a totally different experience than I do. So the question was, will digital assets change the business model? And of course, as EUREX, one of the biggest change, we thought about this as well. And therefore, if it comes to modern portfolio theory, we deal with options and futures. So this is what a portfolio managers need to have to secure, to hedge, to secure the portfolio, and also to invest 100%. And therefore, a future is the valid product for this one. That's why we thought we should start digging down to this world. So that's why we teamed up with a regulated benchmark provider, FTSE, where we then calculate an index, which is also like calculated by the digital asset regulator, which then comes up as an underlying for our future. And this is, I think, essential to have and to provide the market also if it comes to, you said, counterparty risk. This is our clearinghouse. We have a secure clearinghouse there. I think this is some major topics where we can really support this new environment with this new asset marketplace, crypto or funds, whatever you want to build around, having a listed standardized derivatives product which you can use as a portfolio manager in your portfolio. So that's actually the angle why I'm sitting here.
Yeah, absolutely, makes very much sense. You are wrapping digital assets into traditional wrappers and let them be compatible to the traditional world. Startups would do the opposite, and therefore the next question would be, what about the two worlds, old and new? Are they colliding somehow? Are they just covering different market segments or different niches? Is it such that large-scale traditional asset managers are moving into the new fields, or is it startups moving into the old field? What's going on, and who will be the driving force here of the future? Is it the smaller ones tackling the traditional segment, or is it the larger ones tackling the new segments? For example, EUREX, I would also consider you as a larger, of course, player tackling the new segment and getting into competition with recently founded ETN issuers, for example. Yeah, that's basically a similar market. What's your opinion here? Who wants to get started? Also the question wants just to be very precise, are the two worlds colliding, or what's basically going on in terms of movement between new and old?
I think they are complementary, Philipp. The one can't without the other one. So looking at the TradFis, we are, as said, for a couple of years on this topic, but we still need clearly external expertise we get from fintech firms. On the other hand, fintech firms, I've had most recently with one of the biggest 5 US tech companies a meeting with their financial arm, and you've had the impression these guys, they are great in terms of technology, but they have no clue how financial markets are working. And I think the combination of both, and again, driven by demands from our clients, what's beneficial for our clients. That's the most powerful combination at the end. And important for us that not the technology only, but the client is in the focus. So that's every topic related to digital assets, token economy we are focusing on. We are looking from a client angle. Does it deliver value add for the client? Is there the demand from the client side? It's not about the sexiness of DLT blockchain we are talking. It's really what can we deliver to make life for our clients better and to deliver better solutions. And blockchain DLT, digital asset, is a part of the answer, but as I said, we have to see it from a client perspective, combining TradFi know-how with fintech know-how.
I would maybe just chip in one point, because I think this is crucial here, for me at least, when we talk about, again, for example, fund tokenization. I would say I've never heard any retail client or even institution client coming to us and say, hey, I'd like to have a tokenized fund, right? So I think for the industry, of course, it's also a matter of imagination, like what could this result into? And I would say better products for less cost, that must be the ambition somehow. Now, the problem, of course, is we talked about this, some pieces are not yet there, but I guess we as an industry need to figure out how that could work. And obviously here, more agile type of new companies have a different background and might be also helpful for us as incumbents to understand and also get a little bit of a kick in the butt to get our stuff going. So I think at the end it's not consolidation, it's convergence to some extent, and at the end an ecosystem of 1 and 1 gives 3, if I may be a little bit naive at that point in time.
I very much would repeat what you're saying, maybe slightly different words, is that, it goes back to your first question about the Nokia moment. I think the Nokia moment is happening for the traditional firms, but also for some of the fintech firms, in the sense that, in both sides, on one side, you need traditional firms to be a little bit more innovative and adopt some of the same principles, the same operating models, etc. But the fintech firms need to grow up and be more regulated and sometimes be a little bit slower. And I think whoever on both sides makes that will be able to compete with the other. And so I think you end up in 10 years in a place where some of the largest players today will still be there, but there'll be some new ones that come from the fintech world. And on both sides, there'll be some consolidation or disappearance in some case.
Makes very much sense. You want to, please. You want to?
No, I don't want to end. I mean, This is where we, as exchange like EUREX with the future product, are very reluctant. So we are like really relaxed there. I think we an add-on, as you said, we are more in a cooperation there. Whatever is needed, we will help to provide on the asset management industry.
Yeah, makes sense. And I would like to recap on the Nokia moment you introduced and then you also picked up. Would you, the rest of the round, agree that there is a Nokia moment for asset managers, or is this a little bit too dramatic?
So I actually wanted to get back to the Nokia moment as well. I'll use this opportunity. I think that there is a Nokia moment in terms of technology, but there's not really a Nokia moment in terms of, it's just not going to move that fast. And really the only reason is, if we take the Nokia analogy, Apple invented a phone. That's not a regulated market. You can come up with a new phone tomorrow and sell it to customers and nobody's going to come after you. Whereas if you try to do that in finance, you obviously can't do that. No matter how cool your technology is or how great it is, you can't just go out and use it. And I think that's really the only hurdle. So back to the Nokia moment, I don't think it's a Nokia moment for that reason, not because of the technology, not even because of the players, but because the regulation is a speed bump. Which I'm not saying that's a bad thing. I'm just saying that you need to get through that first before you can actually even sell it to people and start getting people engaged.
Did I understand you correctly saying, I'm now very provocative, that regulation is the key reason why this is not a Nokia moment?
Correct. Yeah. I would say so, yeah. And I would say so as someone, we have crypto in our name, so we get very critical questions when we talk to people, obviously. And people always ask, I've been once asked the very normal, the thing that you've heard a lot, whether crypto is just a solution to a problem that doesn't exist. But I think the real problem is that you cannot actually build a solution if you're not allowed to. So in crypto, particularly the asset management example that I mentioned earlier, where we could actually have index products at a fraction of the cost, much more efficient. You're literally not allowed to do that right now, although you could. The technology is there. Tomorrow, you could even solve KYC and AML issues through whitelisting of wallets, etc., etc. But if you're not allowed to, so how are you going to actually get people involved and stuff like that? So
DeFi is an excellent example for this. Just maybe a little bit of a side remark. Please, you're welcome to comment on it. Everybody knows DeFi. It's brilliant. It's the future of the capital market built by smart contracts, and it works very nicely on an individual basis, peer-to-peer, and so on. That's what we have seen. We have trading volume there, and so on and so forth. But since 2 years, it's stuck. and it's just not moving in the domain of professional investors. The idea have been that you guys are joining DeFi, but you first have to white label your address, and then you can join this network. But of course, then the network effects are decreased or slowed down, and this has led to, let's call it, some kind of issues with DeFi right now, because yes, there is some growth, but the growth is simply coming from individual peer-to-peer traders, and the expected join-in of traditional people has not happened due to the reason I just mentioned. So with this, I would just leave you with this statement. Does it make sense, therefore? Because then the limiting factor of speed, again, is regulation, even though the technology would allow you to speed up, but you can't because the regulation is still there and just creating a limit on the speed you can achieve. Does this make sense?
I think so. Let me just add one thing to be clear. I don't mean regulation, whether the existence or the absence. I mean clarity. It could be any types of regulation. It could be strict regulation. It could be not so strict regulation. It should just be clear what it is, rather than no regulation at all. That's not what I mean.
I think it's one of the reasons, right? The thing with DeFi, I mean, it's a very, very recent advent, right? It's been, what, 2 years? So another reason is risk and liquidity, which is just not there yet. Even if you were allowed to do it, it'd be very difficult for a large asset manager to be comfortable releasing a product that could crash the market very quickly, or they would become the, sole single, one of the largest sort of providers in a particular liquidity pool. So, and some of the risks come exactly because of that. Because if you start analyzing some of the largest DEXs and liquidity pools, you'll realize that actually the control is still not that decentralized. So some of it has to do, and that then goes back to macro conditions, because it's still a sort of risky, it's considered a risky asset, right? And it has lower yields at the moment than you get in a money market fund. And so we're just at a point, I think, from a macro perspective, that the liquidity isn't being injected that would allow it to kind of grow a little bit more and have, I mean, regulation is obviously a big part of the reason, but even if you wanted to go offshore and do some of this, you wouldn't probably feel comfortable with some of the risks and the liquidity.
Good point.
If I may just add one point on this, just to also put this in context, I think if you use the term regulation or regulatory framework, we just have to acknowledge this is a highly complex thing. It's not this one regulation. And I mean, we know in some countries we have some regulation that allows certain activities to work on chain. And I think that's exactly, Philipp, you mentioned before, right? Using public blockchain for a certain activity is possible. But the question then, of course, is how do we have cross-border, compatibility? And that's a massive problem, because what I think we as an financial industry and asset manager have to avoid having country-by-country silos. And therefore, I guess we just have to, figure out how that can be connected, and I just feel it's a matter of time. And again, coming back to the the regulatory element, avoiding the Nokia moment. Of course, it's a double-edged sword. On the one hand, regulation is very nice because it protects us from competition, but at the same time, competition will come. So I think the question for us as an industry, when do we want to start to get engaged? And I guess you cannot wait for the moment when you realize, okay, now it's the time to build. You need to start somewhere, obviously in a smart manner. Because obviously you don't want to be too early, but for sure you don't want to be too late. And I think this is, I guess for all of us, something we are considering right now when we try to forecast what is happening next year or in 5 years.
Philipp, I would like to make a positive note on regulation, which from my perspective, from our investors' perspective, is clearly required. So 3-4 years ago, we've had discussion with institutional clients about making use of digital assets, about making use of token economy. And the clear answer was no, we won't step in because there's too little regulation. And when looking at the relationship we as a large asset manager have with our clients, trust is a key element in financial markets, and we've seen with the FTX fuck up what happened, where there was no ring fencing. You've had custody, you've had market making, you've had secondary market platform provider, everything in one hand. And when having no dedicated regulation in place, that's a potential negative consequence, negative outcome. And when losing trust in products, that's the worst thing which can happen for finance industry. Therefore, from our perspective, regulation is really key. Looking at the history of financial markets, it's also obvious that regulation is running at a slower pace than innovation on the technology side. Could give you hundreds of examples in cash equities, in fixed income markets, and therefore you mentioned DeFi. It's not really a surprise that with MiCA 1, which is kicking in next year, DeFi isn't addressed. This might be then MiCA 2, which is somewhere in the pipes. But regulation, as said, in our trustworthy relationship with our investors is really key to make the entire ecosystem functioning.
Absolutely, and therefore, I also want to take now a little bit more positive tone on regulation, talking about new products, because it's regulation then allowing potential new products. In our preparation call, we talked about carbon tokens or tokens related to carbon credits. Does it make sense to also think from a business model perspective about new assets being added? Let's talk about carbon tokens or anything else. What do you have in mind here? What new products, what new assets do make sense in this field to basically think from a business model perspective?
Yeah, the real advantage looking at tokens is you have the fractionalization, meaning you have very low minimum hurdles amounts for retail investors to get accessibility to these products. So nowadays, when looking at alternative assets, you have, 250, 500,000 euros a minimum investment to step in. When looking at bond markets, most bonds which are tradable nowadays have a minimum investment of 10, 50, 100,000 euros. Typically investments, an average retail investors can't afford as a single investment. And that's from my perspective, benefit number one, and benefit number two is a token as a wrapper. You can have hundreds of ideas what you make fungible, tradable as a format of a token, and that's really the big benefit from our perspective for retail investors. So investing will become a kind of new lifestyle factor for retail. What I mentioned before, the breadth of products like in the ESG space, you mentioned carbon products will be huge, and token economy is not just a stupid copy paste from what we have today in a new technology. A token can deliver much more compared to a kind of normal digital document, which is at Clearstream or at Euroclear. And on the other hand, new products will be the future.
Yeah, maybe I'll get on the carbon credit one. And I think if we look at carbon markets today, they're obviously quite intransparent as well. And if you buy a carbon derivative on, I don't know, the CME or so forth, you have no traceability back to the actual credit and where it's coming from and whether that forest or that tree even still exists. Whereas I think that, crypto, for example, can actually offer some benefit there. Where you, at least through kind of the blockchain and the traceability, by having the breadcrumbs, you can, when you purchase a credit in form of an NFT, for example, you at least have the traceability of seeing where it's coming from. So that's why I think there are certain products that are suitable for this type of thing. But I also have to be honest, I think there are a lot of things that are not necessarily suitable. So when people, I guess, want to often tokenize everything, I'm not sure that's really necessary. There's a lot of things that don't necessarily require tokenization, or where in fact, when you tokenize it, you introduce new risks that are very unnecessary. So I don't know, real estate tokenization is a topic that people, I guess, generally love, and I just want to be a devil's advocate there. I think that's the one that I think is a little bit critical, because you're tokenizing something that's inherently extremely illiquid and trying to make it very liquid. But just because you tokenize it doesn't actually change the nature of the asset, right? So I think that we have to be careful. But carbon credits, I thought, was just a good example where you get marginally more transparency, not fully, because you still have somewhere centralized entity, obviously, who has to issue the initial credit, but you get a bit more traceability.
Yeah, but carbon tokens will be a topic tomorrow. That could potentially be a huge topic, and it's not the carbon token full stop. There will be all kinds of shades from black to white, and maybe it could be a discriminating factor between good and bad asset managers, because some of them have access to the good carbon credits and the others only have access to the shady tokens of specific quality, right? Why is this happening? Because there is a huge press of assets awaiting to be tokenized, and then it's exactly, I would agree what you're saying, it does make sense to tokenize everything, but there will be high quality assets and bad quality assets, so potentially from a business model perspective, asset managers could also create some value by providing access to high quality tokenized assets, be it real estate or carbon tokens or art or whatever. Maybe there is a value in not touching specific real assets because of the shady quality. So that's just some thoughts now. Does it make sense or does it not make sense?
I think it does. I think I was gonna slightly disagree and say that on real estate personally, I think it could be that there's structural reasons why it doesn't work well today, because there's a lot of paper-based old legacy systems, right? And you go back to the regulation and all the rest of it. But assuming some of that gets sorted, it's the type of illiquid. I think the rule for me is sort of any asset that is illiquid today and doesn't work well on a centralized infrastructure is sort of ripe for that kind of disruption. I think real estate could benefit from more liquidity and sort of more accurate and faster price discovery, which is what blockchain-based systems do quite well, or sort of tokenized assets on sort of freer exchanges. But I agree, like real estate is perhaps not the best example because of the amount of bureaucracy, legacy bureaucracy that need to change before it's really tradable on a secondary market.
If I just might add here, I think the question about what new assets might become investable, or whether this could be carbon certificates or real estate. I guess for us as an asset manager, that's why we're here, right? Clients are delegating the job of investing on their behalf. So I think it's our job ultimately to make the assessments and to come to a conclusion: is the risk return profile suitable or not? Does it make sense in a portfolio context? And if there are new assets, popping up and meet those requirements or these criteria, of course, I think we just need to make sure we can access these asset pools, both from a trading as well as from an infrastructure perspective. But I guess that's just hopefully underpinning our, the reason for being here also next year and in 10 years, so to speak.
Now, this would have nearly been a very nice closing word, but we have, honestly, one more questions coming up. It might be a little bit academic, but I really liked it when we discussed it in our preparation call, because in the past, there was an asset and it could have been invested. And very often we see the token as something which can be invested. But basically, from the IT structure of a token, you can have various functions on top of that token. I think you brought it up. For example, you could directly connect ESG data to the token, not with crazy APIs and switched together IT infrastructures and things like this, but you could integratedly combine data sources, ESG data, ratings, and so on, directly to the token or inside the token or to the smart contract and all kinds of variants. That's the last question I would very briefly explore, but we have only 1 minute to go. Is this something to think of? Is this something happening, or is this just academic and maybe happening 2030 plus?
Already happening, already discussions we have about it. As said before, a token can deliver much more than a thumb paper document. To give some examples, in the bond space, when it comes to new issuance, you could have a kind of golden source where issuers, where book runners, they add relevant data, static data for us as investors. You can just access via an API. Looking at ESG data, we've had discussions with some corporates. ESG data is key for us. And again, corporates, they can fill a kind of golden source where all investors can have access, and they just can grab the relevant data into their databases. So reporting, data sciences is really key what token can deliver going forward. Therefore, it's not only academic, not only theory.
Yeah, and finally, on this one, we need trust again, right? So this is a trusted source, and I think there we can a lot of do with the tokenization there. So it's really the key factor.
Absolutely, absolutely. You need to have trusted data sources and so on. So therefore, we do not just have to have asset managers moving into the field, but also rating agency and all kinds of other service providers. That's why we do the conference, to bring everybody together. Nice to have you here. There would have been one last question, but time is over. The question would be, what are your competitors doing, right? Because you are here, but the competitors are not here, partly not. So therefore, it's always nice to basically observe the entire market. But it's difficult to bring people here who are not here and ask them, what are you doing, in case they are not appearing here. Perfectly fine. Thanks for being here. That was a very nice discussion talking about the business models.